And my view of it is on a real basis, at least, mid to long-term sovereign bonds, particularly Western sovereign bonds, are uninvestable.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. We find ourselves in a time of transition, one that may increasingly be later described as upheaval. In a week, we'll have a new U.S. president, which will bring change to both the U.S. landscape and to the geopolitical one. We already have a new interest rate regime, as the world's major central banks have pivoted back to cutting rates. And we may be seeing the start of a new era in bond yields, which have been marching higher despite the wishes of the central planners. If this continues as a secular trend, this higher cost of debt could prove destabilizing to the world's hundreds of trillions of dollars worth of debt and entitlement programs. To find out where all this is likely headed and what investors should be tracking most right now, we're fortunate to welcome Luke Gromen, founder of macro research firm FFTT LLC, back to the program. Luke, thanks so much for joining us today.
Thanks for having me back on. It's great to be here, Adam.
All right, Luke. Well, look, I've got a lot of specific questions for you. Like I said in the intro, lots of big topics to dig our arms into. But before we get to them, if I can just ask you the general question I like to kick these interviews off with, what's your current assessment of the global economy and financial markets?
My current assessment is that we're reaching a critical point that we've been talking about for some time, which is the Fed and global central banks screwed up 2 years ago, 2.5 years ago, by not letting real rates stay negative for long enough to get debt to GDP down to levels from which they could manage policy independently without threatening the fiscal position of their sovereigns. And specifically, the Fed did this. In other words, the Fed should have kept interest rates at zero for at least another 2 years before they started raising rates. Politics got involved. And what we've been saying that entire time is, by virtue of that, a day was coming where the Fed was going to have a choice about how they lose the long end of the curve for a moment and then have to move into some version of de facto yield curve control. And it appears that we are reaching that moment. And so, to me, we're seeing symptoms of it in markets. And my view of it is on a real basis, at least, mid to long-term sovereign bonds, particularly Western sovereign bonds, are uninvestable. Which is, we've been hearing over and over, well, China's uninvestable, China's uninvestable, China's uninvestable. And that might be the case. I don't know. But mid to long-term treasury bonds are uninvestable on a real basis. And we can see this. And so we're coming to a really key moment, I think. I think the first trigger point was the 50 basis point rate cut last month. The Fed blinked. The Fed chose. They could lose the long end via cutting, or they could lose the long end via raising. And they look like they've chosen to lose the long end for the moment via cutting. And I think after the election, we're going to see them probably cut again, or at least promise to cut again. And I don't think the long end's going to like it a whole lot. I think they're going to cut again with nominal GDP growing 5 to 6%, with unemployment still at near the lows. And ultimately, I think we'll continue to see what we've been seeing, which is gold outperforming long-term treasuries, Bitcoin outperforming long-term treasuries, stocks outperforming long-term treasuries as we move through the rest of this year and into next year.
Okay. All right. Well, yeah, I think you maybe pulled the punchline of the whole conversation right up to the front here. Okay. So mid to long-term sovereigns, uninvestable, and stocks and hard assets, even though Bitcoin's not a hard asset.
Now, uninvestable on a real basis, to be clear, right? Like the 10-year might go, 4.3 to 4. Hey, great, I made money. But I think if the 10-year goes 4.3 to 4, you're going to have gold go from 2,700 to 3,500 or 4,000. You might have stocks go up a bunch, in my opinion. It's really uninvestable on a real basis for the mid to long term sovereigns.
Okay, so let me just try to clarify this for the average investor that might not be able to wrap their brain around a couple things you said. One is you said that you think that the Fed should have kept interest rates at zero for longer. Correct? I hear that? Okay. To the person who says, well, look, how could they have done that? Because the inflation genie, got out of the bottle and the Fed had to react to that. Didn't that sort of have to force the Fed's hand there? Or do you think the Fed should have kept interest rates lower in the face of that higher inflation?
They should have kept rates at zero. Once you get sovereign debt to GDP to 120%, 125%, you don't have a choice. You don't get to play tough guy anymore. Your choice is 8% to 10% inflation now, and you let debt to GDP fall by virtue of repressing long-term bondholders, or you pretend with debt to GDP at 120% that you're still independent, like the Fed has done over the last 2 years, raise rates, and you drive the setup that we're now seeing, which is the interest and interest-like obligations of the US government are back to 100% of receipts. So now they're sort of stuck. They can keep tightening, in which case you're going to see rates go up because you're going to see receipts fall. You're going to see true interest expense, which is just the interest plus the entitlements, current portion of entitlements. They'll exceed tax receipts. And once you're over tax receipts, the bond market's going to see right through that. And so either we go to boomers and we say, sorry, we cut 20% of your entitlements today forever, and the economy goes into a spiral because that's a lot of money not being put in, or they cut rates to make the interest more affordable. And I think that they've begun doing the latter. And so that's really where the mistake was this time. It's ironic. Everyone's been looking for the next Fed mistake because they always screw up at some point. It's the nature of the job. But it's in the other direction this time. It's in an emerging market direction. Their choice was 8 to 10% inflation from 2020, 2022 through probably today. Or they could pretend they're still tough guys and still in control. They're not in fiscal dominance, which they've been. And if they pretended to do that, sooner or later, math was going to call their bluff. And I think the reason they cut rates 50 basis points is math has begun to call their bluff.
Okay, so I've heard, I think in regards to fiscal dominance, is kind of at its ending. The central banks have to abandon their inflation fighting mandate because at the end of the day, their supreme priority is to keep the debt serviceable. Because if that no longer is the case, then bond vigilantes take the bond market, yields much higher, and then the debt service gets even worse, and that you create this sort of vicious cycle. Are you saying that is the precipice that you see us on right now?
Yeah, that is. And you can see it if you look at the U.S. Interest expense plus entitlement pay-as-you-goes. We're back to 100% of receipts, or we soon will be once we get done repricing debt for another 2 or 3 or 4 months. And that's your decision point. And I think, we're already seeing bond volatility get back to problematic levels as measured by the Move Volatility Index. That was the mistake this time. The mistake this time was that the rules are different when you have debt to GDP of 120 to 130% like we do at the federal level. You got to get it back to 70 to 80. Otherwise, especially in an interest rate sensitive entity, you're going to shrink your receipts and increase your outlays. And that's exactly what's happened. And we've been warning that's what's happened. And you've had these periods of what they've called treasury market dysfunction. We had it in the first episode was really in the third quarter of 2019 with the repo rate spike. And then we had 1Q20 in the depths of COVID, when there should have been a mad dash. And there was initially a mad dash for treasury paper. And then all of a sudden, treasury yields started spiking. Dysfunction. You had it again in 3Q22. You had it in 1Q23. You had it in 3Q23. and kind of here we are. So we've gotten into this fiscal dominance world where they screwed up. They should have. Their choice was not be tough guy and fight inflation. Their choice was try to let a little inflation go now, back in 2022 to get debt to GDP down to a manageable level, or pay the piper later. And the piper's showing up. And that's, last time debt to GDP was this level was after World War II.
Right.
And it was 110% debt to GDP. And US real rates went to negative 13%. And we had capital controls. And they went from 110% debt to GDP to 55% debt to GDP in 5 years. And then Fed Treasury Accord, Fed, you're independent again. They tried to preempt that dynamic and say, hey, we're still independent. And it sort of worked for a cup of coffee in 2022. But now, the fact that US true interest expense, just the entitlements, current portion of entitlements and the interest is basically back to 100% of receipts. It's decision time again. And I think that 50 basis point cut we just saw was a reflection of that.
Okay. Gosh, so much I want to dig into here. Now, I think you'd say there is quite a bit of difference in the America's situation post-World War II versus today, where post-World War II, we had our whole manufacturing base in place here in this country. The rest of the world needed our help in rebuilding. We were entering a period of high economic growth where we have a very different situation today, right? On that you're nodding as I'm saying this, right? So it's easier to grow your way out of that debt to GDP imbalance if your GDP is growing robustly, where we may not have that available to us this time, correct?
Yeah, it's diametrically opposite in almost every way. It's easier when you have your manufacturing base. We don't. We need to print and rebuild it. That's inflationary. That's bad for bonds on a real basis. It's easier when everybody else in the world's manufacturing base has been largely or entirely destroyed. That's not now. Now they have our old base. Ours has been destroyed. It's easier when 7% of the world's population has been killed in war. And so there's tight labor markets, and the US has the best labor force, the only really intact labor force, even with the 400,000 or so casualties we took. It was nothing like the 20 million the Russians took or the 10 million the Germans took, what have you. Apples and oranges again. And so it's a very, very different scenario in every single way. In every single way, it's in the opposite direction that is inflationary for the US or terrible for mid to long-term bonds on a real basis. Like, we can rebuild. That's not the issue. We will rebuild. But to rebuild mid and long-term US Treasury bonds have to get destroyed on a real basis. And that process has begun, but I think it's going to get a lot worse. And that's what I think ultimately the importance of this true interest expense going back to 100% is. The Fed was raising rates like the world existed the way it was 10 years ago, 20 years ago, 40 years ago, 80 years ago. And it's simply untrue, right? It's like me saying I'm gonna go try out for the Cleveland Browns at my age because, you know what, once I was a mediocre high school football player, and what could possibly go wrong? Well, same kind of thing. It's like, well, we'll just raise rates, we'll fight inflation. Like, no. Okay. But if certain things don't happen, all you're going to do is jack up your interest expense. You're going to take down your receipts. You're going to put yourself into fiscal dominance. And now you're going to face a real choice. And that is, the choice is straightforward. It's either you slash entitlements and defense by 25 to 35% immediately, permanently, put the United States into a Great Depression that is far worse than what we saw in 08, except the Fed doesn't come to help you this time. And it spirals on itself, or you financially repress the heck out of your bondholders. And there's really only one choice. They're not going to do the first.
Okay, so let's talk about that. Because I was going to say, okay, so what really are the options here? And I'm going to say of the central planners, not just of the Fed, because I don't want folks to think it's just the Fed. A huge part of fiscal dominance is the fiscal side of things, right? And right now, at least, the fiscal side doesn't show any signs of wanting to apply the brakes. And I mean, that's Congress. They don't have the discipline. They only exert it once it's forced on them. And we've got two presidential candidates who've now made their platforms pretty clear, and both platforms involve a lot of additional spending at this point in time, right? So, you know, the Fed can control the short end of the interest rate curve. As Bill Fleckenstein likes to say, he's concerned we're getting to a point, which I think is pretty much the exact same point that you're concerned about, where he says the bond market takes away the printing press from the Fed. You know, where it basically says, Fed, you can do whatever you want on the short end of the curve. I don't believe you've got the system under control, and I'm going to demand higher yields on the long end to get compensated for this additional risk. So, so the Fed can pull that lever all at once. The bond market doesn't necessarily have to go along with it. What can be done here? Is it just the Fed, you know, pushing rates down? Yeah, maybe that has inflationary outcomes. And then as bond yields start rising, as the vigilantes start driving it up, it's just out there buying at the long end of the curve, like aggressive QE on the long end.
Well, it's interesting, right? Because if you look at the data, the Fed really didn't sell anything on the long end during this period of QT, which I think is enormously instructive. I had that chart, those Fed charts put in front of me the other day. Like a lot of the QT is done at the mid and short end, which is very instructive. Tells you that this, you know, especially in an inverted yield curve, right? That tells you,
Right.
in theory, they should have been. So why didn't they? Either they're stupid or they couldn't. Those are really the only choices. And I don't think they're stupid. I think they couldn't, not in the sizes that they had. So the choices are really, as you get into this problem, you'll see what we've already seen for over a year now, right? Which is, you know, third quarter of 23, the bond market was revolting. I mean, you were having dysfunction again for the third time in 12 months in the bond market or in the treasury market. And so what did Yellen do? Well, she shifted issuance to the front end. And so we're already 12 months into her shifting issuance to the front end to kind of keep everything together. Ultimately, that's something they can do. Realistically, I think ultimately the Fed's going to have to buy it. You know, they're going to have to go back. You know, you'd see what we'd see you know, a month ago, which is the Fed cutting rates when they really didn't need to cut rates. And I think they're going to keep doing it. And, you know, because that's really, those are your release valves. Your release valves are three, and they're very straightforward. Productivity miracle, slash entitlements and defense by 25 to 35% immediately and permanently, and then sit tight as you go into a new Great Depression, which mathematically you absolutely would. And by the way, that may end up with your debt to GDP higher, not lower. Your deficits higher, not lower, because your tax receipts would
Because your
collapse.
GDP is going down. Yeah.
Go fast. Or you cut rates, you cut interest expense. And that's what they've started doing. And I think that's what they're going to keep doing.
Okay, but so they're cutting it. So let's just look at the knock-on effects of that. So the Fed continues to aggressively cut rates from here. What then manifests from then on?
I think you're going to see higher rates of inflation. I think a reacceleration in inflation. I think you'll see a reacceleration in growth. You know, I think at some point you'll need some additional forms of capital controls that are probably more aggressive than what we've already seen. They've been sort of regulatory to this point. Maybe we see more regulatory sorts of capital controls, things like money market fund reforms in 2014, pension fund reforms in 2018. These types of things where you see more regulatory encouragement of ownership of treasuries. There's things you can do there.
So would this look something like all pension funds need to have at least 25% of their capital in long-dated U.S. treasuries or something like that? They just
to retain their tax deferred status or something like that. Sure,
yeah,
you could do something like that. And that's the kind of thing you'd expect to see at some point. I don't think we're there to that level of it yet, but all of this ultimately depends on the level of the dollar, right? Like this discussion, a level of the dollar and the level of inflation, right? If we run it, you know, if you get the dollar down, you get inflation up, you get receipts up, you get that true interest expense that's currently 100% and moving higher, it will move lower. And now suddenly you're not quite in that fiscal dominance dynamic where you don't have a choice. But that is ultimately higher inflation, negative real interest rates. Bondholders have to lose on a real basis. They may be fine nominally, but they have to lose on a real basis in order for that to work.
Okay, and just to help folks understand, and this is probably pretty clear, but what Lucas, reason why he's focusing on a real basis is the real rate essentially is a bond yield minus the inflation rate. The higher inflation goes, the inflation rate goes relative to bond yields, you get a smaller and smaller real return until at such point you're actually getting a negative real return. That would be inflation rate higher than bond yields. You're nodding as I'm saying all this, Luke. And of course, that makes sense why you think things like gold and Bitcoin would do particularly well, because oftentimes when compared to bonds, people will say, well, look, those assets don't have a yield on them, right? Well, no yield starts to look really good compared to negative yield, right?
Well, particularly when it's a flexible face value, right? So like
Right.
gold is just a 0% yielding bond of infinite duration and infinite face value, whereas a U.S. Treasury bond is a whatever percent yielding bond of fixed face value and fixed duration, which in plain English means they can inflate gold as much as they want. They can only inflate treasury bonds to basically a zero rate nominally. And so whatever that equates to on the price of the bond, that's as high as it can go. And so after that, you lose on a real basis as inflation picks up further, basically.
Oh, okay. So we're making our way to talk about the impact on the currency, the purchasing power of our currency, which is a drum I beat a lot on this channel, and I think you're adding a lot of volume to that in this discussion already with the context that you've been setting. But somebody might listen to your projection there of what this might mean. Well, inflation goes up, capital controls come in, GDP goes up, so a little bad, a little good. We're no longer spending all of our tax receipts on the debt because we've got the interest rate down a bit. To me, that just sort of sounds like, more can kicking, more like, well, how can we limp along here? To me, that doesn't sound like a long-term plan. Like at some point, you still get to a reckoning. How do you see this manifesting over the next couple of years, if indeed this is the path we pursue, which I agree to you seems like the most probable one? Is it that consumers begin to buckle under the higher inflation? Is it that, I don't know, the bond vigilantes get real mad and they start driving bond yields up faster than the Fed can control them? Like, where does this begin to have problems for the policymakers who choose this path?
Yeah, it's ultimately you run into political problems, right? So arguably we're already there on that front in terms of the contentiousness of our election, right? We've had what, 2 attempted assassinations this year of a presidential candidate. We're starting to get into the political fallout of this.
Well, certainly,
Presumably
sorry to
along
interrupt,
this.
but unaffordability, general unaffordability is by far the biggest voter issue, right? And both candidates are trying to wrap their arms around that as much as possible. I'm going to be the one to help address that. But very clearly, we're at a point now where the population is saying the economy is not working for me. Presumably, that gets worse in this path. Does it?
Yeah, they've let this go to a point where there are a series of difficult choices where you're trying to determine who's going to lose on a real basis, right? So you can cut rates to zero and restart QE, in which case asset holders are going to win and inflation's going to resume and fixed income and lower income are going to be hurt. And okay, right? That's one trade-off. Look, if 60 million to the 70 million baby boomers died in the next 2 years, okay, baby boomers lose, healthcare obligations, Medicare, Medicaid, Social Security collapse in terms of their obligations. That's another way out of this. That's a trade-off.
Okay,
Not
but that's not going to
advocating.
happen. We're not going to lose that many baby boomers in 2
I
years.
wouldn't think. I wouldn't think so. I wouldn't think so. But that's again, just I exaggerate for effect. But that's another trade-off within this issue. You can, in theory, cut defense spending. You can reshore and deficit spend a lot and have negative real interest rates and invest. And that's going to be really good for middle working classes, asset holders. That's going to work for everybody. It's terrible for bondholders. They're going to lose on a real basis. And so it really comes down to, do the bondholders win or lose on a real basis? Do the boomers win or lose on a real basis? Does the military win or lose on a real? You can look at your big stakeholders in the existing system. Does the banking system, does the financial, finance, insurance, real estate industry win or lose on a real basis? And all of the, you can, you tell me the lever, I can tell you who wins and who loses. The fact that the stakes are so high and the adjustments that need to be made are so draconian because we have not had the political courage to do anything in this country for 30 years. And in fact, we've been going in the wrong direction in terms of these wars and et cetera. So we're running up our debt for absolutely no productive return, means that we're now past the point of marginal changes. You need to make wholesale cuts to the bone and muscle. And, I think that's part of the reason why we're getting the political toxicity that we're getting, is someone's going to get hurt and someone's going to bleed a lot. And, they're hoping that if we just cut off an arm or a leg and we, sort of patch it up from a fiscal standpoint, that everything can kind of keep going. But nobody wants to be the guy to lose the arm or the leg for the greater good. And why would they? Because America has been about, me and not the greater good. And, oh, by the way, there's two greater goods. What's the greater good for Wall Street and Washington, and what's the greater good for the rest of us? And so sort of, when Washington and Wall Street step up and say, oh, you guys, I know you fought for a false war, and I know we bailed out Wall Street, but not you, Mr. Homeowner, and I know, but now we need you to lose a leg. And they're like, no. And so that's this, this political toxicity, the fact that we've had 2 assassination attempts on a presidential candidate in 5 months, it's symptomatic of this. And it's, from when you say, okay, what does that mean for markets? Doesn't say go buy bonds, I'll tell you that, because financial instability, sovereign instability, you don't put your money in a long-term fixed rate instrument. You just don't. You buy gold, you buy Bitcoin, maybe you buy some stocks. So I think markets are reflecting that the fact that we've reached a discussion where it isn't, hey, we need to miss a couple meals. We're beyond we need to miss a couple meals, to sort of make this work, to make the math work. We are now, who's going to lose their leg? And no one wants to lose their leg.
Yeah, and I think that's sort of what I'm trying to dig into here, which is like I don't necessarily see the transition from status quo to this new world you're talking about happening quickly, like in the next 6 months to year, simply because I don't see anybody who's out there recommending even cutting off a limb at this point in time. I guess I would say, if I can, I'm not a political analyst, so I'm probably overlooking a lot. I think the Trump side is saying, let's gut wasteful government spending. So maybe there's some limbs there. And I think Harris is saying things like, let's tax unrealized capital gains, let's raise the corporate tax. So those will I guess cut some limbs there too. I just don't know if either of those is anywhere near big enough to address the size of the problem that you're raising here. And so my question is sort of like, do you see this as something that's going to be playing out over the next couple of years to decade plus, where just increasingly bond holders will become the losers for all the reasons that you've mentioned? But in terms of like the real reforms that we're going to need, like I said, I just don't see those happening anytime really soon. I see things having to get even more volatile from a populist standpoint. You've mentioned the assassination attempts. I think those are signs of volatility and outrage. I think, though, it's probably going to have to get a lot worse before they're saying things like, we have to cut military spending by 20% permanently, or something like that, right? So are we heading into maybe a decade, as I said at the beginning of this, of increased upheaval, as the populace and other aggrieved parties increasingly are pushing for the type of political reforms that will eventually open the door for the really major cuts we're going to need going forward?
Probably. You can see, they say, well, we're gonna cut. Cut where? From the Trump side, cut where? Cut where? Right? So,
and it's easy to say on the campaign, right?
of course, yeah, right.
Yeah.
Because the only things you can cut that matter are entitlements, defense, and interest. So to my initial point, like, guess what they're cutting? They're cutting interest. They shouldn't be cutting rates, but they have to. There's really nothing else they can cut that matters. To the other side, hey, let's tax unrealized gains. Capital's going to run. Capital will just leave. And now you're not going to have any capital to tax. And you're in the same spot. And so I think it's going to be bumpy, but I also think if they don't get it figured out, it's going to accelerate pretty meaningfully. The other way you do this is like what Israel did in the 80s, which is, 2 years of 300 to 500% inflation. Thank you for your donation, bondholders. Away we go. You'd have to put capital controls up, but that's, Israel was a smaller economy. It was a more unilateral or it wasn't as diversified as ours. It was smaller than ours, et cetera, et cetera. But some level, you're going to have, these things don't resolve themselves linearly. It's little by little and all at once. And so, Trump could come in say, hey, I got 2 years. I'm going to revalue gold. I'm going to buy back treasuries. I'm going to revalue gold, put the money in the Treasury General account, buy back treasury debt, take treasury debt down to 40% debt to GDP. And now I'm going to reinvest in reindustrializing, and away we go. That would work. And it could be done quickly. And it would be done on a real basis over the backs of bondholders. Or you could do it, the outlook, the alternative for bondholders, in my opinion, is what we saw in 1900 and 1982, which is real rates were -1% on average for 80 years. And we're in year what? 5, 10 of negative real rates for bondholders, -15, only another 65 years to go for negative real rates for bondholders, that pace, if we bleed it out. In which case, why do I want to own long-term debt? And I think that's why we're seeing issuance shift to the front end, is they can't issue it at the long end because everyone's looking at it going, like, I don't know when this is going to work out this way, but I know how it's going to work out, which is sovereign's going to do what they always do. They're going to stick it to mid and long-term bondholders on a real basis.
Okay, so let's talk about regular investors and just regular people too, because not everybody owns financial assets. So regular person listening to this says, okay, wow, I'm looking through Luke's eyes. I don't want to own mid to long-term bonds going forward, at least not sovereigns. So they can buy gold, Bitcoin, hard assets that can't be, their intrinsic value can't be inflated away, and they can own stocks, which presumably you think will do generally okay, at least in certain parts of this cycle. So that's one way to try to keep your wealth from getting eaten up, the purchasing power of your wealth from getting eaten up by the inflation that comes along with all this. If you don't have substantial financial assets, are you just continually getting grinded away here by increasing inflation going forward? And of course, that's on top of the 25+% of loss of purchasing power we've already, the regular households already taken from the start of COVID, right? So are basically the beatings just going to continue for those folks?
Some of it depends, right? So you tell me how quickly AI is going to show up and how quickly robotics are going to show up. Both of those things are extraordinarily deflationary on their face. And if you import a bunch of labor like we've been doing to sort of cap labor inflation like we've been doing, and then 2 years later turn around and be like, well, I know we brought in a bunch of labor, but we don't need you because we have AI and robotics doing it for us. Now you've now you've got to inflate, right? Because you can't not pay those people. They gotta, they're gonna be drawn on the system. You're gonna have to pay them, welfare entitlements, etc. So, there's a way where, there isn't necessarily inflation, but there is an increase in unrest and an increase in deficits that ultimately end in inflation. But that's like it's some of it requires in terms of, okay, are we going to just get more inflation, more inflation? I think it's going to come in waves from a political standpoint of all else equal, what we're seeing in AI and robotics, et cetera, is deflationary. Problem is deflationary does not work for if you have a government debt that is the size of our government debt. That just doesn't work. So what do we go right back to sort of the beginning? Like, okay, well, deflation pushes receipts below interest, and then they have to print the interest, which is inflationary. So I don't have a great answer for how the path evolves sort of month to month, but I think inflation ultimately has to move higher because the government debt is not sustainable without it. And the
Right.
government's not going to short themselves. We've seen that over and over and over. Um, Alan Greenspan said that 10 years ago. Look, there's zero chance that they're going to cut Social Security, Medicare, Medicaid when the trust funds run out. Zero chance.
Right, right. What did Greenspan say? He said, "Hey, I can nominally meet any obligation that the U.S. can nominally meet any obligation it has. I just can't tell you what the purchasing power is going to be when I write those checks." Right, and that's where I'm trying to go with this, Luke. Which is, I hear you saying, okay, it's going to be a rockier road for investors because you can't own bonds. You want to take mid to long term bonds off the table here. Um, and what I was trying to get with this question, which I think you answered, which is, okay, separate from just investing, just life for the average person, what's that going to be like in this path that you think that the central planners are going to take? And from what I hear from you is, yeah, it'll be up and down, but it's going to be sort of an increasing inflationary headwind along the way. And I know you've got
Yeah,
kids.
I mean, it's very, it's holding everything else constant. I think stuff you need will get more expensive, and stuff that's sort of, optional or luxury, will probably get a little cheaper. So healthcare, shelter, food, all the stuff you need that they want to X out of the CPI readings probably keep getting more expensive. And sort of, the college, throw that in there, education, however that looks, and sort of the stuff that it's, maybe you have, maybe you don't. You probably continue to see deflation in that, and they'll continue to shift the CPI indices towards that stuff and away from the stuff you need, right? So you get like, one of Paul Krugman or whoever's like ridiculous, X food, shelter, and sort of everything I need to live.
Right,
Like
right.
inflation's 2%, the Fed won. I was right. Like, okay, great. Why don't you go say that to some, union guy in Cleveland who's,
Well,
send a kid to college and feeding his family who, he plays football. Go say that to him. Let me be there to watch because I think it'd be really funny.
okay, great. And that's exactly who I'm asking this question on behalf of. So we'll wrap up in just a sec with your kind of your nearer term market outlook and any other assets you want to mention besides the ones that we already had that you think investors should consider for this moment that we're in. But let me ask you this question, which is, I know you've got kids and they're at the age where they're heading off into the world. What do you tell them in terms of, hey, these are success practices I think you might want to focus on for, prospering in this more challenging future that you guys are stepping into?
Stay out of debt unless it's productive. I tell them that I think it matters less and less where their kids go to college these days, where they get an education, and more that they don't go into debt to do so if they can avoid, or at least the least amount of debt possible to do so.
And
and
sorry to
more.
interrupt, but I would also say probably, and also maybe a little more focus on making sure if you go to higher education, you come out with a more marketable skill than just a,
Yeah,
you know, fun degree while you're there.
no, I think that's right. I think that's right. And so you're in this, it's a, I tell them don't get too worked up about any of it because things are moving so fast that, if you want to retain optionality, and that's ultimately what stay out of debt and get a degree of something that is useful today, um, is about retaining optionality. You come out of college with a lot of debt and a useless degree, your optionality is screwed for the next 2 decades. You probably can't afford to buy a house. You probably can't afford to change your job if you hate it. You probably can't afford to make. And so for me, things are moving so fast. I'm basically telling them retain optionality. Be of good character. Don't take on non-productive debt. Um, if you can do those things, a lot of what we're seeing in technology and et cetera is leveling the playing field greatly. I'm living proof of it, right? I'm a
Right.
friggin' ugly bald guy from Cleveland, and I think I do a decent job, and I certainly am able to be up on stages with people that are far better educated and far better looking than me, and so that I think speaks to the power of the internet and sort of your ability to self-improve, educate, etc., in a fast-moving world. So, um, that is ultimately how I'd answer that. I don't have a great, I mean, I can tell you what we've told our boys, which is like, stay out of debt, only take on debt for productive things, be of high character, understand the monetary system, right? So we've all had them read the Bitcoin standard. Because to me, for my boys are 18 through 23, it is I think a very, Safety does a great job just sort of explaining it in a way an 18 to 23-year-old can understand. All three of my boys would be first in line to go sign up to defend this country, literally, if there was a threat in this country. But understand that over there, not our fight. And so stay away. We've told all of them, don't, for what? For what? So that's what I've told my own boys. I can't,
All right. Well, no, I appreciate your sharing. I agree just about everything you said there, except I think you're being unduly harsh on your looks, Luke. I think you'll get some pushback from some of the viewers here.
Thank you.
Okay, so you've answered the question. I guess just the last part in it is, we're Gen X. I think we look at the baby boomer generation and we do say, they had it a bit better than we did. And I think millennials are probably looking at and Gen Zs are looking at us and the boomers and saying those guys had it even better than we did. I guess your kids are probably Gen Z.
Yeah, they're Gen Z. They're like 20, 23, 20, 21, and 18. So
Yeah. So, but do you think that they're going to have legitimately a tougher time than we did, given all these forces that you're talking about here? They're going to be playing out over the large scale of the next couple of decades in their lives?
I think it depends on. I think there's more opportunity for them and a more even playing field, but also a lot more downside. I think
Okay.
it's much more, you see these 23-year-olds and some of them are, they get a YouTube channel and they have something that's of interest and they build it out and they're making 10, $12 million a year. Like they're making more than a lot of professional athletes. And then there's others that are, getting a degree in the humanities at, Harvard for 400 grand and not that employable. And like, they're sort of debt slaves. And so like you have this bifurcation. And I guess when I describe it that way, it's kind of the old world and the new world, which is, look, 4 years ago, 5 years ago, that 23-year-old, if they were standing next to each other at high school graduation and one was going to Harvard and one was like, I don't know what I'm going to do. I'm going to maybe mess around with the internet. You'd go, loser, that's the path to success. And the reality has proven out in a lot of times that, well, it's not so black and white. Like, look, if you got your humanities degree and you love it and you know, that's what you want to do, and you're 400 grand in debt and like, you know, you're living paycheck to paycheck to pay off your loans. Great. Okay. Awesome. And the other guy was, you know, the internet's a great leveler in terms of like that kid might have been a screw off, but now he's making $5 million a year because he's tapped into some sort of you know, social vein, or it's just it's the great evener of competitiveness, of talent. And so that's what I mean of like, hey, what, you know, staying out of debt gives you more optionality. You know, there's a lot of opportunity, but it's also extremely competitive, right? It's very, you know, it's just
right. Well,
can you
in the internet, yeah, we're heading off in different direction I expected when we started this interview, but this is actually really interesting territory. But yeah, so I agree with you. I agree with everything you're saying. The proactive, you know, young person who's really keyed into the major trends that are going on, they've got a lot more opportunity to really seize, you know, the market opportunity out there than they did before. But yeah, to your point, especially if you're leaning into technology, increasingly that competition is not just with other American kids doing this; it's with the world, right? Because the geographic barriers come down when you go digital, right? You're nodding pretty vigorously as I'm saying this. Okay, great. Look, I want to return to the you know, your any parting advice you have sort of for investors here, but I guess the last thing on this is, I agree the individual that follows your recipe there is going to have a much higher likelihood of success going forward. I worry, and I'm happy to be disabused of this, I worry that on average, or maybe I'll say at the median, because I spent a lot of time talking about the difference between the average and the median. I worry, based on the macro trends that you've laid out here, that the median household is going to have a tougher time of staying out of debt, because just for one, interest rates will likely be higher, but inflation is going to erode the purchasing power of their currency. So, you know, their income's going to buy less. Inflation will make things more expensive. The debt's going to be more expensive. Again, this is all averages relative to now. You know, if we're not dramatically goosing GDP as part of this whole process here, just the ability to get out there and make a living may be more challenged. Do you share that concern at the median, or do you have a greater sense of optimism here?
I mean, I think it's challenging to me, right? Because if I look and say, okay, like I think 70% of the wealth of this country is held by 55 plus year olds, right? So they have 114 trillion. So some of what you just laid out is, you tell me how fast they're going to die, and I'll tell you how valid that is.
Got it.
Right.
Because
So
if the wealth transfer happens sooner, then obviously we'll be able to absorb. Yeah.
Right. Not only will the wealth absorb, but you'll be going from people that are trying to save and sort of coast in, you know, in terms of making sure their nest egg doesn't run out before they die, to a bunch of younger people who are in peak spending years. And so
Yep.
the multiplier of that wealth explodes, you know, by a factor instantly, basically, right? You take, you know, $10 million, $5 million from a 72-year-old or a 75-year-old to a 45-year-old, the multiplier on that money is going to go up instantly by a factor, which is great for growth. It's great for inflation. And on the flip side, the liability portion at the sovereign level drops, right? So some of it is like, how fast does the greatest generation and boom, I guess they're mostly passed on, but sort of the silent generation, I guess it is now mostly, and the boomers pass on. And how fast does their 70% of the wealth flow down to Gen X and on down? And if it happens fast, that's one picture. And if it happens slow, that's a different picture. And that's I don't know how to answer it per se of like, now some of that is very aristocratic in nature, right? All of a sudden, you're no longer talking about the world necessarily that you and I grew up in, or that the boomers grew up in of America, and much more like a old world, oligopoly, oligopoly is not the right word, but aristocracy on some level. So there's a lot of moving parts, and how it goes, there's great variability in the outcomes, I guess is what I'm saying. Is so that's, in the past, it used to seem to be like the range of outcomes was here, and now the range of outcomes
Is broader.
is much broader. Like, look, I mean, 70 million boomers. If, they have 114 trillion, sorry, 55 and up have 114 trillion in wealth. If half of them are dead in 5 years for comet hits us, growth is going to explode. Job opportunities are going to explode. The wealth is going to transfer down. There's going to be a multiplier on that wealth. Growth is going to blow people's minds, and away we go. And if that doesn't happen, and oh, by the way, the Fed's, because the debt is so high, the Fed's probably going to have to cap yields for that reason on the upside. And
Yep.
if that doesn't happen, if they all live to 100, then the borrowing's going to explode, the wealth inequality is going to explode further, and the Fed's going to have to cap and print borrowing for that reason too. And that's why I say the Fed screwed up in 22 by not letting it go higher for longer, because now they're stuck. Either way, they're gonna have to cut into 5 to 6% nominal. They're gonna have to. They have begun cutting rates into
Right.
5 to 6% nominal GDP, reaccelerating inflation. And you take a step back and look at what's going on geopolitically. There is zero chance we are cutting defense spending. There is zero chance politically in this environment. We've already had 2 assassination attempts on one candidate, though this is no longer speculative. There is zero chance anyone can cut any social spending. So what's left to cut? Rates is the only other thing that's big enough, and they're doing it. And so it's, to me, on a real basis, bonds are uninvestable beyond, I don't know, 2 years, 1 year. Like, own bills all you want, roll them, great. But for bonds, people should own gold and Bitcoin. And then I think stocks do well too.
Okay, great. So we're here at the end then, and maybe you've just answered my last question. Beyond gold, Bitcoin, and stocks in general, any other refining of the beam of the type of assets that you're looking at, given the regime that we're in right now?
No, I really think we've now reached the point where, on a real basis, mid to long-term bonds are basically, especially sovereign bonds, are just, they're unownable. They're uninvestable, to use the word applied to China for the last couple of years by a lot of people. And we'll probably get forced to own them at some point, but that's neither here nor there. We touched on that already.
Yeah.
Ultimately, we're in this regime where not only is the debt, even if the system wasn't changing, that would be the outcome. But now when you talk about, well, we're splitting with China, we're forcing, you saw this huge repatriation of assets back to China after China started doing the stimulus. You saw the flows. So now, as America, you've got to replace the lost Chinese flows, finance the deficit from all of the prior actions, and you've got to invest for growth. Who wants to own a long-term bond in that? The biggest owner of long-term bonds is selling. They don't have the funds, right? Already we have entitlements plus interest is 100% of receipts as it stands now. And if interest rates go up, that will go up, that percentage, just by virtue of the private sector shrinking because it's interest rate sensitive and the interest expense going up. And we're allegedly going to do all of this bringing back and make America great again and reshoring. And if you look at the 2 presidential candidates, they're not that different. Kamala's talking about a national stockpile for raw materials like nickel. What? Like, no, don't get me wrong. It's the right thing to do. And it's the same policy either way.
Yep.
So, remind me again why I want to own my duration exposure in a fixed income instrument like bonds as opposed to gold, Bitcoin, and stocks? And the answer is, like, I don't think you're going to lose a ton of money on bonds, because every time the 10-year gets to, if in the US gets to 4.6, the bond market throws up on itself, and the Fed comes in and assuages all of the volatility and with more liquidity, and that's fine. And the release valve is stocks go higher, gold goes higher, Bitcoin goes higher. And I think that's going to continue to be the playbook going forward, which is, own gold, own a little Bitcoin, own stocks. And on a real basis, mid to long-term sovereign debt is uninvestable now, in my opinion. It's just on a real basis.
Got it. All right. The last question, this before we wrap up. You know, I warn a lot about focusing on preserving the purchasing power of your wealth because of the pressures on the currency. And I think you just used the same terminology I use an awful lot, where you said it's the pressure valve, right? So when you say the pressure valve is that gold and Bitcoin go a lot higher, that's really the pressure valve is that the currency is where the collateral damage, the purchasing power of the currency is where the collateral damage happens, and gold and Bitcoin are reflecting that drop in purchasing power, correct?
Yeah, more than reflecting it, really, because ultimately you're going to see a lot of people that own long-term bonds at the sovereign level on down fleeing into it for safety. I think you've already seen that to a certain extent at the sovereign. You have seen it at the central bank level.
Exactly. They've started swapping, long-term
and
sovereigns largely
I mean,
treasuries.
it's exactly. So I think you're gonna continue to see that, and the $130 trillion in global bonds, and 18, 16 trillion in gold, and $1.4 trillion in Bitcoin. Those the gold and Bitcoin bags have to get a lot bigger to hold that much in sovereign debt. Particularly when they'll be back. The policymakers will be backfilling it, right? Because it's not like, well, they'll just sell bonds until the bonds get small enough and those two equal out. Well, no, because the Fed screwed up and Western central banks screwed up by not letting the debt, the inflation, work the debt down enough. So they can't afford, we know the US government cannot afford over 4.8, 5%. We've seen them hop to it every time the 10-year gets to 4.8 or 5. So not only is there 130 trillion in debt that needs to squeeze into 18 trillion in gold and $1.4 trillion or whatever in Bitcoin, but they're going to be backfilling the 130 trillion as it shrinks nominally, because they can't afford the rate over 5. They go into a death spiral because they did the wrong thing. They did the uncourageous thing 2 years ago. They should have screwed bondholders 2 years ago with 2 years of 8 to 10% inflation and move on. I don't know if they could have, but that's what they should have tried to do. They didn't. They wanted to be tough guy, and now they're going to get what they wanted good and hard.
All right. Well, we'll have to end it on that. Well, look, as you talked about, there's a wide sort of option set of the things that could happen going forward. Luke, we're just going to have you back on the program again frequently in the future as your schedule allows, to kind of give us audible updates as to where things are along here. Very much appreciate your time. For folks that have really enjoyed this conversation, would like to follow you and your work, where should they go?
Sure. FFTT-LLC.com for more information on our institutional and mass market products. And you can find me on X at Luke Gromen, LukeGromen.
Awesome. All right. And Luke, when I edit this, I'll put up the links to both your website and your X handle there on the screen, so folks know exactly where to go. Folks, links will also be provided in the description below this video. Folks, if you really enjoyed this conversation with Luke, would like to have him come back on again at some point when he sees something important enough out there to make an audible call, please let him know that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And if you'd like some help in potentially putting into practice in your own personal portfolio, some of the investment ideas that Luke shared with us here, highly recommend that most viewers do that under the guidance of a good professional financial advisor, but one that takes into account all the macro issues and challenges that Luke laid out here. When you put that requirement in, the universe of good financial advisors with that expertise shrinks pretty smallly. So if you'd like to have a free consultation with one of the financial advisors that Thoughtful Money endorses, you can do that just by going to thoughtfulmoney.com, filling out the short form there. Only takes you a couple of seconds. And these consultations are totally free. There's no commitment to work with them. There's no strings attached. They'll just hear your personal situation and they'll give you their advice on what they think you should do, and you can do whatever you want with that. Luke, again, wonderful discussion. Definitely very eyebrow raising. Mid to long-term sovereign bonds are uninvestable. Really appreciate you coming back on the channel here, Luke. And like I said, you're welcome back on anytime you want to get an important new update out into the world.
Uninvestable on a real basis. Uninvestable
On a
on a
real
real
basis.
basis. That's cases. Yep, absolutely. No, absolutely. Thanks for having me on, Adam. It's great being here again. I always enjoy catching up with you.
Thanks, my friend. Everybody else, thanks so much for watching.